And that means we are live here on our halftime report, Tackle Trading's daily stock market show, where we go through markets, commodities, Forex, futures, the news of the day, the charts that are grabbing our attention. Have some fun while we're doing it and try to give you guys some insight and some analysis that can help you out there understand this wonky market that we're in. Several things on today's show. Number one, markets are selling precipitously for the first time in some time. We're going to break it all down. The headlines are kind of making it sound like it's about second wave fears and the Federal Reserve. We'll give you guys our take on that, whether we believe that or not. We're going to look at the charts. Some of the pullbacks in the distressed industries are grabbing our attention. Is interesting. Other volatility plays and whatnot. But as always, we got a full crew, a very exciting show planned for you. A couple things before I introduce the coaches. If you are new to our channel, welcome out. It's great to have you. We do this show each and every day at 12:30 Eastern, whenever the markets are open. Click subscribe, click the bell, come back and join us. And without further ado, let's get everybody in here. We got Mark, we've got Noah, we've got Coach Greg Holmes from Tackle Trading and the Rookie Corner blog. We've got Cody producing on the back end, and we've got Matt as our lead analyst here. Let's start with you, Matt. How you doing, sir?
You know, Tim, I'm excited for this pullback. I really am. You know, it's what we talked about earlier this week on Monday and Tuesday about, I asked the question about if we were seeing rotation, the same type of question I asked 3 weeks ago regarding the rotation from the stay-at-home plays into the value stocks. And we're starting to see that come to fruition here throughout the entire week. And quite frankly, I mean, we can talk about the headlines of what, Market Watch or FinViz or, Seeking Alpha or Reuters, Bloomberg, Yahoo Finance, whatever it is, right? You can talk about the headlines about, the concerns about the second virus outbreak, or, concerns about what the Fed said with the GDP projections for 2020 and 2021, or, whatever the case might be out there. The simple reality was we were overextended, elevated in price in those economy reopening plays. And, as said on Monday and Tuesday, it's time to lock in profit in those areas of the market and wait for a pullback there. And so, in my opinion, and this is just one man, but I like the pullback here, and I think the pullback is well overdue. And it might kick out some of those new traders in the marketplace, but let's see how those pullbacks settle out at support. But I truly do believe this was long overdue, number one, and not unexpected. This is what we were talking about on Monday and Tuesday with the rotation coming out of those economy reopening plays.
Yeah, it's the biggest red candle since the middle of March when we were in those, limit down type days. And obviously every trader who's been a veteran and been in this business for a long time, we've been waiting for some kind of pullback or sell off to kind of reset these charts. Mark, what's your instinct on a day like today? Before we break down the specifics of the technicals, I'll have Noah do this here in just a second. Just first reactions though, because this is a huge, red candle there, welcomed by a lot of traders like Matt talked about. I'm excited about it, but Mark, what's your read?
My instinct is that this is a momentum, not shift per se, but I mean, come on, when you had so many areas of the market go parabolic almost for a week and a half, and what happens? FOMO, froth, exuberance, the feeling of invulnerability, right? That people get over leveraged, people put way too much money out there. And then when it starts to go the other way, they panic because they've been so used to seeing green on their portfolio screen. And I'm up, and oh my gosh, I'm going to make $1 million this month. And then all of a sudden, boom. And I think it's this reality check, and it's a huge educational moment. But and we can get into that later. But as far as my instinct, this is because it's not a real catalyst. It's not like a new trade war or the Fed raising the interest rates or like we saw with the virus when it spread to South Korea and Italy and it became this real thing. This feels like over leverage speculation gone wrong, and people just are like, I can lose money in the stock market, and boom, panic.
Mm-hmm. So, it feels like Wall Street putting an attack on Main Street to a certain extent, Mark, because There is nothing new here today, guys. Mark, you're absolutely 100% right. There is no news that was unexpected. There's no news that we have not been talking about for weeks and weeks and weeks. I truly believe that, the market was simply, too hot, too fast, overextended, especially in a lot of those, stay-at-home plays. And we started to see slowing momentum in those plays. Earlier this week, we started to see a little bit of, price, consolidation coming down a little bit. You saw it across the board with the airlines. You saw it with the financial plays. You saw it with the industrial plays. You saw it with the cruise lines. You saw it with, every one of those distressed areas that they had went up very, very quickly. They got completely overextended coming into major resistance zones. You saw slowing momentum at those areas. And then you saw, stop losses get absolutely destroyed over the last 24 hours and the market's coming down. I'm seeing this currently, though, as, and for the love of all things good and holy in the world, please, please, please give me a doji tomorrow.
Yeah.
Do not just don't give me a 5% update tomorrow. Just don't do it. Give me a doji tomorrow. Reestablish support levels. Reestablish traditional technical setups. Give us a doji going into the weekend. Let the traders take the weekend to go run their scans, run their technicals, because there could be some really, really, really strong plays. If tomorrow, guys, honestly speaking, if tomorrow goes up 5%, I'm going to miss out on a lot of that because
I'm going to miss out on everything.
What's the over under on it recovering today and giving you a hammer back up above that 9-period moving average?
But no, I would personally, I would hate that.
I know. I'm just saying, but I mean, it's not unlikely.
No, it's not. We still got 2.5 hours left in the trading day. I don't think it's going to happen. But nothing would surprise or shock me in this marketplace. But again, on days like today, for traders, traditional technical traders, they don't want to see. Literally, if the day ended today, they would be fine. They would be perfectly fine. They would celebrate. They'd be like, yes, finally, we locked in profit on Monday and Tuesday. Let's reassess for next Monday and Tuesday, and we'll take a look at technically some of those technical setups in, the distressed areas of the market coming back down into support levels. But I am going to do a rain dance later on before the market closes, just praying for a doji. Just give me a doji tomorrow. Give me some technical setups that, we can see slowing momentum at support levels, that we can map out, swing trades with entries above the doji high and stop losses underneath support. If the market recovers in hammer fashion today, or if the market tomorrow goes up 5%, it's good for the investors, but it's not good for the traders outside of day traders.
Mm-hmm. Before we get to Noah breaking down the chart, Greg, I want to get your take on all of this as well. I think very appropriate to have you on here today, and welcome back to the Halftime Report. I really enjoyed your blog, Greg, because you were talking about some of the hubris and arrogance, and I even think you said the word braggadocious as to some of the participants you'd been seeing in the market here, bragging about how much money they were making on the way up and all that kind of stuff. And that kind of clicked something in your instincts there. And you even wrote about this before the sell-off here today. Greg, what's your read on this market condition right now?
Well, like Matt, I think this is long overdue. I've been finding myself recently kind of taking more stock in the fundamental and like just the whole fundamental picture, not necessarily of a specific company or anything like that, but just kind of the overall nature of what we're seeing here. Something that's blown my mind in the last couple of weeks, and I've talked about this ad nauseum, is people buying into bankrupt companies and airlines, like the airlines, the distressed equities that Matt was talking about, just jumping 20, 30, 40%. Like I'm sitting back going, how is that possible? Like they won't even let us get on a plane here in Canada. You know what I mean? So it's kind of insane to me from that respect. Now, being that I've traded a while, I've seen this kind of exuberance before. Never seen it to the point where it's got braggadocious until just yesterday. But
sure.
The thing for me looking at this is I saw a lot of divergences in the market. I saw a lot of indicators that like just the distance between, say, the and where the market was at. it usually, the rubber band called the stock market usually doesn't get stretched that much. And so I felt that we were totally due for this. And of course, having been around this game a little while, I've seen, some folks get so excited, I guess they use the term FOMO now, but I just get so excited that they're making a boatload of money, and then all of a sudden, it just ends. And that's the way the market seems to always work.
Well,
and so sorry, go ahead, Matt.
Well, and Greg, just to kind of go on that point, I mean, you take a lot of those plays that have been just skyrocketing in, specifically the very distressed areas of the market, the cruise lines, the airlines, the banks, those, I'm not even going to mention the bankrupt companies because that's just absolutely just craziness there. But I mean, no logical sense in any capacity on those. But you take a look at those, a lot of money has been made in the last week to 2 weeks in those from those bounces. I mean, we at Tackle, we were all over those airline bounces coming off the reversal patterns, and they were coming into very, very easy targets where you should have been locking in profit at that point. But I mean, I felt like Kramer made a great point today when he was giving an interview on CNBC, and give credit where credit's due. But I also think it was a little bit of tongue in cheek, a little bit of a dagger to some of the uneducated areas of the new traders to the market. And he said, let's kind of wait for the day to end out. Let's see how they handle those, how those new day traders handle the margin calls. Let's see how they handle that before we get too premature about buying this dip. But it's fascinating to see this, see the market reaction today on a day where, quite frankly, go through the news, guys. It's the same news that's been around for the last 3 weeks. There's the Fed, and I'm sure we'll get into the Fed after Noah breaks down the technicals here today, Tim. But the Fed guys, Mark, I know you listened to everything Jerome Powell said yesterday, as I did. I know you scoured all the articles the same way I did. But in your opinion, did Jay Powell say anything yesterday that we didn't already know, or the Fed hasn't already talked about?
I mean, Jay, if to tackle trading community, no. I mean, we've been very clear at Tackle Trading, especially from an investing standpoint, that the bears have several amazing articles. I would read that text that Keith King sent you right now. I think that says
I
it
don't
better.
know. I don't know, because it like Greg was just ripping on the braggadocious.
I know, but it's going to say it better than I could.
Well,
right.
Okay, so and I'm sure Keith's not upset with me for reading this on a live channel. I might get a further text later on today, Mark. But in essence, Keith and I we talked quite a bit about these types of things on the podcast this week. I hope you guys enjoyed the podcast this week. If you've not done so, definitely go ahead and download that podcast with Keith. But he basically just said, in a nutshell, he thinks the entire Wall Street analyst community and the Federal Reserve were listening to the Trading Justice podcast on Monday. During the podcast, all of us were very clear in our message that Wall Street and analysts were completely wrong on their mistaken beliefs that the economy was roaring back and that there was a net increase in jobs. Victory for Tackle, victory for Trading Justice, and victory for brains and common sense. Loss for Wall Street, loss for Wall Street analysts, loss for CNBC talking heads claiming the great unemployment report proved the economy is having a dramatic V-shaped recovery. And my first thought after Keith sent me that text this morning, I was like, he must be having a really good trading day, like a really good trading day, because Keith is a futures day trader and he loves trading these environments. I mean, I do believe one of Keith's best months he's ever had trading was in March when we saw that initial breakdown. Yeah. So I'm sure Keith, is just piling Benjamins right now from a short-term trading perspective, but. It's what we've seen in the economic data. I've never believed in the V-shaped recovery. You got to trade the momentum of the market. You got to trust your systems. But at the end of the day, I've said numerous times, Tim, that the labor market's going to take years to recover. Years to recover. Anybody who expects GDP just to snap back all they're listening to is talking heads trying to pump you to buy stock and politicians who need the market to recover for their reelection campaign. And you can take that for whatever it is, but that's the reality of the situation. Anybody who is data driven understands that the economy is going to take a long time to recover. And the only thing you need to justify that opinion is the Fed from yesterday literally stating that they are not even thinking about raising rates. They're not going to pull the support from their aid to the market. And quite frankly, they're not even concerned about elevated asset prices because they're more focused on, fixing the economy. And if you look at the dot plot and what they said yesterday, and again, we'll get into this into some detail, they're not projecting any rate increase through 2022, guys. 2022. Yeah. No rate increases for 2022. That should tell you everything you need to know about the true state of the economy. It's still a house of cards out there. And I hope in everything good that we do see a quicker recovery than I anticipate. I just don't see the economy recovering. Guys, it took literally 7 to 8 years for the economy to recover the drop in 2008. Economics take long term. Trading, short term. Stock market, short term. Economics, they take a long time to get back to where you were.
Mm-hmm. Mm-hmm. And that Fed stuff is fascinating, no question about it. I do want to talk about that here in just a minute. Noah, before we do that though, break this chart down for me, and specifically because it will help us lead into the conversation about the Fed statement and whether or not it has anything to do with this market. Start with a weekly chart, give me the big picture, then down to the daily. And on the daily chart, Noah, spend a little bit of time on the candle sizes because there's that old mindset in the market of how the bulls take the stairs and the bears take the elevator. I mean, we're literally giving back 10, 15 candles in one day here. So it's really fascinating. And then go down to the intraday chart, and Noah, look at yesterday after the Fed into today. And let's break it all down if we can. You're on mute. Come back in here, and you are up, my friend.
There we go. Unmuted. Well, before I dive into all the technical analysis and have all that fun, I just want to toot my own horn and post a little tweet that I responded to last night, 12 hours ago. There's some braggadocious for you. NASDAQ hits all-time high. Tremendous progress being made, way ahead of schedule. Does this mean we should sell? All right. I just want to put that out there. I nailed it. Okay. Well, first of all, the context from the weekly chart I think was really, really interesting, Tim. As you zoom in on that, one of the first things I was watching as the market hit this level on the S&P specifically was the old support zone back here. So, prior to the big meltdown, we had this big support pivot. And that to me right there, that kind of a setup right there, and I probably shouldn't draw that type of line. Let me pick a better line, is really, that's a kiss goodbye zone right there. So that technical zone, I've had my eye on. Of course, I had my eye on all the other support zones as it climbed. So it came up and it was just rip roaring, had pretty good momentum on the weekly chart, came right up into that little kiss goodbye zone, and then boom. So old support did become new resistance. And we saw the little, slowdown in the chart on the daily chart. As you can see, the price is rising up into that area. We had pretty good momentum, really good momentum, except for the last 2-3 days, we saw some selling signals, some warning signs, a slowdown between these two candles. So we had a nice big green candle showing strength. Then we saw a smaller green candle followed by a small inside red candle. And then with yesterday's response, we saw a little bit of selling after the Fed made their announcement, but then it failed to take out that high. So when it failed to take out that high, I think that's part of what leads to the selling and when we break it down to the intraday chart, you'll see the failed rally off of the Fed numbers. So let me get down in there intraday. Let's see if we go down to a 15-minute chart. Here you can see the Fed announcement yesterday, right when it came out. It, shot down, rallied up, came up, retested those highs. And when it held and it failed, then you see the selling come in. And by the end of the day, it had sold back down and taken out the, previous lows during the intraday and was kind of sitting down there at support. Mm-hmm. Overnight, we saw it break and prices started to head down. And what I've been watching really closely now on the daily chart is prices have sold off pretty heavily. And the size of this candle, is really remarkable. I can't remember who wrote it, but somebody said this was one of the biggest candles since the March lows.
Mid-March, yeah.
Well, biggest red candle for sure. I mean,
Mhm.
if you look at since the March lows, there's a couple big doozy green candles in there that are probably bigger. Like one of these, a couple candles are bigger, but that's the biggest selling day. And again, it's coming right down to that 20 period moving average. And there is some support resistance in here with the 200 period moving average. And I'm wondering if we're going to see a short-term rebound here intraday. It's, down here on a 30-minute chart, 15-minute chart, somewhere in that neighborhood. This is a 30-minute chart. You're seeing it really, really rip down. Lots of downward momentum. I'm watching to see if we're going to get a sharp intraday recovery just because it's hitting that 20 period moving average. And that can kick in some of the algos.
Where's the first breaker at? 7%?
It is 7%, I believe, is what it is. 5%.
Mark, or is it 5? Because we're almost 5% down right now. 4.7. I mean,
No, I think it's
7%. I think, yeah. I mean, here's the thing that accelerated
It's
selling
5% on the futures overnight. It's 7% during the
during the day.
During the
trading day. Yeah. So, I mean, here's the thing. We're down 4.7%. Obviously, we're selling precipitously. We're coming into some levels that are very interesting on daily charts. But guys, there's nothing on that intraday chart that can hold this thing up in terms of that regard. Now, could it find a bottom from the daily chart? A little profit taking on the back end? You bet, maybe. We're down 4.7%. But I got to get everybody's take on this. The stated reason from the news I first read this morning was that the reason the markets are selling is because the Fed came out and said what they said. I believe that's garbage. Matt, what about you?
Say again, T?
Do you believe the reason the market's selling is because the Fed statement?
No.
Not at all. It didn't sell yesterday on the information. Jerome Powell didn't say anything new that we didn't already hear from him a week ago, 2 weeks ago. They've been projecting dire economic consequences for a long time. In fact, the Fed statement, in my personal opinion, was a reaffirmation of their dovish stance, willing to maintain policy for 2 years, and they don't care about asset prices bubbling. So don't give me the reason the markets are down is because the Fed. I just don't buy into that. Mark, what about you?
I don't. I mean, listen, I watched every second of Powell's speech yesterday, and while it didn't tell us anything new, I think it was a wake-up call when they projected, and this wasn't in Powell's speech, but this was in the Fed notes. They expected unemployment to be around 9% at the end of the year, like 6% or 7% next year, and 5%, 5.4% in 2022, somewhere in those things. And I think individuals maybe were like, oh, I thought we were going to V-shape, because that's not a V-shape, right? If we're still at 7% at the end of 2021, that's not a V-shaped recovery. And so I think it was a wake-up call to some people. But once again, I really think this is a lot of panic. For me, it will be interesting how much powder retail traders have in the keg. Do they see this as a buying opportunity in the coming days? Do they have, how leveraged are they, right? How much available cash do they have? Or are they all in already? So,
or maybe the smart money, the big money. They're waiting for all those rookies who this is the worst day they've ever seen in the financial world. No day has ever been worse than this because they've only been trading for the last 2 months and, putting all their, all their savings and all their, checks have been getting into the government, into penny stocks and bankrupt companies and, valuations that didn't matter. And Wall Street's going to wait to let them get all shooken out. And then Wall Street comes in and buys. I just come back to one simple reality. Yes, we're focused on today's day. We're down close to 5% in the S&P 500. The Russell 2000 is getting its teeth kicked in today. The NASDAQ not down as much. But, I look at days like today, and yes, the news headlines are going to be all over it because the news headlines got to give it a headline, right? But the simple reality is we were seeing slowing momentum in those areas on Monday and Tuesday. When you look at the energy sector, for example, if you'll stay with me on this one. If you look at the energy sector for a second, in the energy sector here, what was going on as it was prices were getting elevated. You were coming up into known resistance areas. You had a slowing momentum candle on Monday. You had a downward movement in price on Tuesday. And then post-Fed, you had volatility coming out and a tough close coming into the market on Wednesday afternoon. Nothing today should be unexpected from a selling perspective. What should have been unexpected is people coming in just and buying. When you look at the financial sector on Monday, what happens? On last Friday, it kisses off the 200-day moving average. Where does it go from there after it hits the two? Please go to financials, Noah. When you're looking at financials again, I'll wait for Noah to catch up. When you're looking at financials here on last Friday, you kiss off the 200-day moving average, a major area of resistance. You slow your momentum down on Monday. This is what I was talking about on Monday and Tuesday, slowing momentum, money coming out of those areas of the market. You should aggressively trail up stop losses, lock in profit. That is all things we were talking about on Monday and Tuesday. And it simply had nothing to do with the headlines, had nothing to do with the economics, had nothing to do with the justifiable or lack thereof of actions people are taking into the market. You were simply completely overextended in the short term. You were hitting into resistance areas. You were seeing slowing momentum from a candlestick perspective, and you were seeing downward movements in charts. When you're looking at the consumer staples sector, same type of thing is happening. When you're looking at, when you look at, these distressed areas of the market, when you take a look at the industrial sector and specifically the airlines, Delta, JetBlue, American, United, all of these airlines, what was happening? They were skyrocketing in value, coming off the lows very, very aggressively, slowing their momentum, downward movements in price. Those are technical setups or technical reasons why traders start locking in profit, and why we said on Monday and Tuesday, you don't chase the dragon up here. The Apple trade was on Friday last week or Monday this week. You don't chase it after it's already made its tremendous movements. Timing is absolutely everything from a short-term trading perspective. And the headlines today are going to be all about, the Fed paints this dire picture of the economy. All right. Thank you, Market Watch. Thank you, CNBC, for saying the same thing the Fed has been saying for 6 weeks now. The Fed, Jay Powell has not came out and said we're going to have a V-shaped recovery. I haven't heard that out of anybody at the Fed, not named Karkashi. That's the only individual at the Fed who has talked about a V-shaped recovery. The Fed speeches have painted dire economic situations. The Fed was projecting 20 to 30% decreases in GDP for the second quarter. They were projecting 25% unemployment. And so when you're looking at the Fed, when you're looking at the OECD, when you're looking at the World Bank, when you're looking at the IMF, when you're looking at global economics, and the market is just celebrating the economy simply reopening up and everybody's going to act normally again, that's not the picture that has been painted out of the banks. I talked about this yesterday, literally before the Fed even came out. That's not the picture of the World Bank, the IMF, the Bank of International Settlements, central banks from around the world, including the United States Central Bank. That is not what their projections have been. There was this hope that we were going to get back to normal. There was this built up surge that we were going to get back to normal, but that was just not in the data. Economically, this is going to take a long time to recover. We have to dig in and understand that. And I'm not saying take the hope away. I hope for a better economy in the third quarter than the second quarter. I hope we recover by the end of 2020. I just don't believe that's ever going to happen. If you want to look at it from a probability perspective, nothing is 100% either way. But I would put it at a 1 to 2 delta if we're going to have a V-shaped economic recovery. And so the sell-off we're seeing today, it is just a continuation, in my opinion, of what we started seeing on Monday, Tuesday, coming into the Fed on Wednesday, about how we were seeing money come out of these distressed areas of the market in preparation for the Fed. And now I'm seeing a capitulation post-Fed. And quite frankly, I'm also seeing it as now a buying opportunity. I love the retracements we're starting to see in these distressed areas of the market. Now, I don't think we should just buy the dip. That's why I said I want to see a doji, but I see this now as that resetting of a potential buying opportunity, because I just don't believe the headlines today. I just don't. They're just, they have to give a headline to something. But I loved, these airlines coming back down into support. I love the energy sector coming back down into support. I love those distressed areas coming back into support. We need to see them confirm with slowing momentum the same way we saw them slow momentum on the top side. So we're just going to have to wait and see on that.
Yeah, I mean, you think about it, Matt. How many people, when things were running up over the last week and a half, in fact, I just got a text from someone said, should I buy some MGM? You know, like how many people that if you get a little stability, a little slowing momentum are like, oh, I missed out on that. I'm going to get back in, especially if it sells out more and then you get a technical thing. It could be a great trading opportunity coming up.
Well,
We just wait for the technical signals.
Yeah, take MGM for a second. A lot of this action that we saw here today, there's been some follow through on the cash open in the broader markets, but in a lot of these distressed areas, like you're looking at MGM now, a lot of that happened on the overnight action. I mean, the market was down. The Dow was down 750 points coming into the cash open. The S&P was down 3% coming into the cash open. MGM gap down, Delta gap down, American gap down. These distressed areas of the market, the energy, finance, they all gap down. But where did they gap down into? MGM gaps down into a previous known area of support. It also gaps down into the 20-day moving average, and you start to see slowing momentum on an intraday perspective. That's what we want to see from a buyer's perspective coming into really probably not even tomorrow, but coming into Monday and Tuesday of next week. We want to see these distressed areas of the market maintain their support levels, maintain the previous levels of resistance acting as new support, maintain that 20-day moving average, see some slowing momentum in those charts, and then you can start mapping out probability analysis, return versus risk analysis on some potential really, really good trade setups coming into next week.
Yeah.
Now, and you know me, man, I'm a sky is falling kind of guy, right? If I see anything out there that is like, oh my goodness, the virus news, if that's what this is not that severe as far as big picture, right? I don't know. I'm totally with you on this. Give me some technical setups. Like, hey, mate, the market might fall another 4%. We don't know when that setup will occur. Just do not rally 4% tomorrow. For the love of everything, I know that would help my naked puts. That would be terrible.
Traders don't want it. Maybe a day trader wants it. Okay. So sure. A day trader would want it, but traders want that setup that Doji Matt talked about, or even just slowing momentum, some setups over the weekend, getting ready for a Monday, Tuesday type setup. I think that's what we want. Mark, you did mention the virus type thing. That's the second reason I'm hearing from all the news outlets, so to speak, that the second wave virus risk is one of the reasons why the market's selling. Mark, what is there any credence to that?
Well, I mean, we're seeing spikes. Like, listen, now that the riots have died down, what is CNN publishing? They're publishing more virus things.
It's back to virus news.
And so it's back to virus news now that there's nothing on the front page. And I mean, we're seeing in Arizona and Texas, particularly, hospitalizations go up in Arizona. The virus
Utah,
is never. What?
Utah as well.
Yeah, no, the virus hasn't gone away, nor has it gone away. We totally botched the handling of this from the start, but it's not exacerbating to a level to cause a true market panic. We're seeing little increases in certain places, totally expected. Does anyone think, and I want to ask every individual, does anyone think that we are not moving forward with reopening?
We are not shutting down the economy.
Oh, I think that ship sailed.
Yeah, Mnuchin even came out today and said, there's no way we can shut down the economy again. But, Mark, yeah, we're seeing, like, CNN is really driving me nuts these days. But they shift back to the virus, and the virus this and the virus that and the virus this. But when you're looking at those cases of the 19 states that are seeing increases in cases, you also have 21 states that are seeing decreases in cases. And some of the increases is due to increasing testing and whatnot, but you're not seeing an epicenter of the virus. You're not seeing a Seattle. You're not seeing a New York City. You're not seeing a Wuhan. You're not seeing a Florence, Italy. You're not seeing that epicenter where you have just massive cases start to increase. So you're seeing a moderate increase across the board in 19 states. You're seeing decreases, but you're not seeing an epicenter. And, we have positive data coming out from a vaccine. I mean, Moderna back in the news today, phase 3 trials starting in July. Eli Lilly, COVID-19 treatment could be available by September if 2 antibody treatments go well. Regeneron came out today, started clinical trials of 2 antibody treatments as well. So you're not seeing that massive wave we saw in the first wave. So even if we get a second wave, if it's broad-based and slow, our healthcare system is not going to be overwhelmed and overran, which means we'll be able to handle it. We've had just a massive movement in treatments, antibody studies, vaccines as well. So, even if we do see a moderate second wave, I don't see the economy shutting down again. I just don't.
Yeah.
No.
And no, bring up that chart on Moderna if you can, because I actually think this is a really interesting data point, at least for one day, mRNA. And, all those 3 stocks, Matt, had interesting virus news. But forever, guys, whenever we got positive virus news, whether it was out of Moderna or Eli Lilly or Regeneron or any of the companies that came out with, treatments or trials or vaccines, market popped on it. And the market, this is why I don't believe in the second wave is why the markets are selling. We had positive virus news today. Moderna moving forward with that trial, Matt, is huge news. That's the final phase, I believe, and that they're going to start in July. So the market is not even using this positive news in any way. The market's just selling technically. Mark,
I don't think with the increased intelligence collectively we have as a society today versus what we were going through when everything was so new in January, February, and March. I don't think it's going to set the panic in again, though, because think back to what we were going through late January, early February, before it really came to the U.S. And we were looking at mortality rates at 3%. We were looking at, death and destruction and mayhem. And people were talking about this pandemic wiping out hundreds of millions of people, and everybody was scared out of their minds. And, it was a very, very shockingly scary situation. But we have a lot of more intelligence and information on this now that mortality rates aren't nearly as bad as once were projected, that the transmission of the virus is not nearly as devastating as we once thought. Yeah. Everybody was wearing gloves going to a convenience store because if they randomly touch something, they might die type philosophy out there. We know that's not true now. So we just simply have a lot more knowledge now about how, and I'm not trying to minimize the virus. That's not what I'm trying to do. I still social distance. I still, treat it with concern. I just don't think society has the same amount of risk that we thought we might have. I think we overshot. And I don't blame anybody for overshooting coming into February, March, because it was a very, very scary, unprecedented situation for our society. But we now have a lot more information on that. So I don't see you might see pockets of businesses shutting down. You might see pockets of states saying that, okay, let's minimize this little outbreak. But I just do not see I do not believe we'll see a national economic shutdown again. I just don't believe.
Cody, I want to get your take. I know I saw you come off your mic. You had something to say there about this.
I was going to say that I agree with Matt that we're not going to see another shutdown, and one of the reasons why is because we have that scientific news and that data. I feel like we forget that this is still 7 months new to science. It was unknown. Yeah. We knew nothing about this. We could only speculate because it was a relative of the SARS virus. It's within the same speciation of all the COVID viruses. So as we learn more, we know that, everything that Matt just covered, it's not transmittable. We have some vaccines and some different treatments and therapeutics coming through. And the best point is the whole point of shutting down was to stop the hospitals from becoming overwhelmed. Hospitals have a plethora of supplies now because we've been building these supplies for the past 4 months. So we're not going to see another shutdown. Yeah.
Anytime somebody says the word plethora, I have to respond with, would you say they have a plethora?
Yes,
that'll be a movie. I don't know the movie. What movie?
But also,
that's like from Romancing the Stone, way back in the 80s. Come on.
The idea when we first did the shutdown was because of the unknowns, and the philosophy was A, don't overwhelm the healthcare system, and B, it's better to overshoot and protect more people than it is to undershoot and let it run wild. That was the idea. So I agree that we're not going to see another shutdown because hospitals are more prepared and we know more about the virus than we did before. I don't see another shutdown, and I'm glad they switched to just saying second wave versus second outbreak, because I don't think we're going to have a second outbreak by any means.
Yeah, and I'm with all you guys on all this. We've got to move on. We got a lot to unpack here in today's show, and obviously it's a big day, so we're going to have a lot to say about these major points. And the charts are fascinating, but let's go to Forex Factory real quick, and let's kind of break down some of the economic data we haven't got to yet. Because Matt, it wasn't just FOMC and virus talk and the market selling. We also have some information on jobs, and I believe even the PPI numbers came out. Matt, you're my economic analyst here. Break those numbers down if you can.
PPI report came in very similar to the CPI report, negative 0.1%. That was on core PPI. PPI, which is the Producers Price Index, which is a leading indicator for the core CPI, because the producers typically pass on the rate of inflation to the consumers. And so PPI leading, core CPI lagging. PPI report, again, if the Fed needed, I said this about the CPI report yesterday before the Fed announcement, if the Fed needed justifiable economic data to justify their dovish policy, they got it today. And that's what we saw coming out of the Fed later today. And the PPI report just reaffirmed that belief in terms of the inflationary impact right now. Inflation, I do want to remind the Fed, is a historically slow lagging indicator. So simply because they pumped 3 trillion in balance sheet and 2 trillion in debt, by the way, congratulations to the United States. I said this on Twitter. Congratulations to the United States. It took 2 months to hit 2 trillion in additional debt. We went from 24 to 26 trillion in 2 months. It took the United States government over 200 years to hit the first trillion, but it only took us 2 months to hit the next 2 trillion. That is absolutely fascinating.
We're getting better at it, Matt. We're getting
better.
Much
more efficient. And I just want to once again remind everybody, where are the conservatives? I'm not going to get on that soapbox, but where are the conservatives in the market today? It's absolutely insane.
They're dead. They're dead.
Oh, they're gone. They're a dinosaur at this point.
There is no fiscal conservative in government right now.
You know what, Cody? I believe there will be in the future, but they are not today.
So.
Here's the risk. Here's the risk we have in this conversation.
Let me finish very quickly. But initial claims also came in today. That has been a catalyst for buyers today. When you saw consecutively week after week seeing slowing momentum from a labor perspective, we saw that again today. We had 1.89 million initial claims last week. We have 1.54 million this week. That is now 10 consecutive weeks where we've seen decreasing initial claims numbers. I do see that as a positive, even though the market is selling on that news today. But I want to talk about the Fed very quickly and get everybody's take on the Fed, because we really haven't talked about it yet. And they're the major catalyst that everybody's talking about over the last 24 hours. Just a couple bullet points, and then I'll throw it to the team to give us your thoughts here. FOMC yesterday, 0 interest rate through 2022. A couple other things. They're going to expand the Main Street lending program. Also, they're projecting GDP at a negative 6.5% in 2020. They're expecting 5% growth coming back up into 2021. That is not a V-shaped recovery projection. That is a U-shaped economic projection, which I believe most everybody believes we're actually going to get. There's only a certain demographic, which I'm not going to get into, that expects a V-shaped recovery here. Unemployment, they finally gave us some projections on where they feel the labor market's going to be by the end of the year. They've hinted to it, but they finally gave us their projections. They expect unemployment to bottom. Let me rephrase. They stated that due to the labor numbers that came out last Friday, you could see a bottom in the labor market, i.e., you could. I don't believe it, but they did say you could. They didn't project it. They said you could see a bottom. And if you do see a bottom, the projection is 9.3% unemployment by the end of the year. Once again, not a V-shaped recovery analysis. They also threw a little bit of cold water, and this is something that I feel is concerning to all of us as Americans, that millions of people, it will take years for them to come back to the labor market, if they come back at all. And they're talking about those individuals in the industrial companies that might just be priced out of the labor market. And that's very, very concerning. They did state the same thing they always state. The committee expects to maintain this target range until it is confident that the economy has weathered recent events and is on track to achieve maximum employment and the price stability. A couple other points, and then I'll throw it to the team to discuss very quickly. The dot plot. The dot plot was fascinating. Of the 17 voting members that put in the dot plot, only 2 of them had any projections above 0 interest rates through 2022. The 2 individuals that did have projections above that, they were about between 0.5% and 1%. That shows you that the Fed is lock, stock, and barrel, just basically saying we are in line with one another. We are not having an interest rate increase in any capacity for the next couple of years. And I, quite frankly, I'm not sure. I am not sold on the fact that they may ever see an interest rate increase again. I think 0 might just be traditional from here on out. So we'll see how that works out. They're also ending the tapering. This is very, very, very dovish. This might be the most dovish of what the Fed did yesterday. They are ending the tapering of its asset purchases. First and foremost, I didn't know the Fed was tapering anything in any capacity because their numbers have been so big, big, big. But they are ending the tapering of their asset purchases, meaning they're going to be buying $20 billion in U.S. Treasuries not monthly, Tim, every single week. In addition to the $20 billion in Treasuries they're going to be buying every single week, $22.5 billion in quantitative easing every single week. Find me something over the last 12 years of Fed policy that is more dovish than that one. $42.5 billion every single week in asset purchases while they extend their Main Street lending program. William Dudley, who has never seen an interest rate decrease he did not love and has never seen an increase in the balance sheet that he did not celebrate, he's probably popping champagne right now at 2 o'clock in the afternoon. He basically said, we don't think this is going to end until $10 trillion in balance sheet. And quite frankly, quite specifically, the question that was asked, the one question that I truly wanted to hear, because nothing Jay Powell said yesterday was surprising to me. The one question I wanted to hear was if he was concerned about elevated asset prices, i.e., the Fed's monetary policy creating a bubble-like condition where the market does not assess risk and only assesses return. And on that question, he was quick to end the press conference on that question. He didn't want to go into the detail, but he did state what we want is investors to be pricing in risk. But here's the kicker. Here's the kicker, guys. We're not looking at any particular level, i.e., they could care less about elevated bubble-like conditions in the stock market. And he went on to say this in justifying his logic there. And this is just disgusting to me. But what he said was the concept that we would hold back because we think asset prices are too high, what would happen to the people we serve? And what he was trying to suggest there is that if they pull back on their dovish monetary policy, it's going to hurt the people that they are sworn to serve, i.e. the American people. And that is one of the most just ridiculous statements I've ever heard out of any central bank president. And Bernanke has a closet full of ridiculous statements. But to suggest that they're doing this to help Main Street America and they're not concerned about the 1% of the population who controls more than 50% of the stock market is absolutely insane. But the takeaway is this: they are not going to adjust their dovish monetary policy regardless of how elevated prices get from a valuation perspective.
Mm-hmm. Mm-hmm.
It's the most dovish thing I've ever heard a Fed speaker say, and that is saying something.
It is. It is.
So,
There's nothing they said, though, that's unexpected. I mean, there's not a single thing that you just went through that makes me say, holy cow, that's out of left field. I couldn't have ever thought that they were going to come out and say that.
Well,
they've been talking about
frankly, for them to-
economics.
I'm going to disagree with that, Tim. The Fed does not come out and say they don't care about elevated stock prices. They don't ever say that. They don't
did it shock you?
They don't even want to be even tied to the stock market. They hate the fact that their monetary policy is the reasons the market's up 400%. They hate the fact that, that most people in America that has any understanding in any capacity about the Fed, they hate the fact that they're known for just elevated prices. I was a little surprised that Jay Powell came out and said that, they're not going to adjust their monetary policy regardless of what happens to asset prices. That tells me that, guys, if you come back to the very beginning of the Fed, they have a dual mandate. Mandate number one, maximize the labor market. create a monetary policy that encourages businesses to borrow money, to increase their business, to hire people, to maximize the labor market. In doing so, mandate number 2, control inflation. Well, guys, inflation is in asset prices, real estate prices, stock prices, commodity prices. That's where inflation lives. And so when they came out and said, we're not going to adjust our monetary policy regardless of what one of those asset prices do, they are going against what their mandate is, in my opinion. And so, yes, that was a little surprising for Jay Powell to come out and say that. I was a little surprised by it.
Yeah, I get it. I mean, but dude, I know they watch the stock market. They may not want to be tied to it,
No,
obviously.
of course.
Obviously
of
they do.
course. I mean, how much evidence do we need to have for 12 straight years? Anytime the market went down, the Fed pumped in money. Of course, they're concerned about the stock market, but they never admitted it. Jay Powell finally admitted it yesterday. That is shocking. To say he's not concerned about elevated asset prices is a violation of the Fed mandate in controlling inflation, in my opinion.
Yeah. You know, the one thing about having this conversation with Greg here, and I know it's triggering him in many, many different ways because he's a fiscal conservative, number one, but I'm sure he just wants to tell us, guys, if you think it's bad there, come to Canada. I've seen that. I've had this conversation with Greg many, many times. Greg, obviously national debts are going up. The Fed is coming out and saying what they're saying. What's your reaction to the economics of this?
Well, the one thing that struck me most, I guess, is their numbers for the unemployment. I've been talking to a few folks here that are, how do I say this politely without getting myself in trouble, closely connected to Fortune 500 companies. And this virus has brought to light the ability for people to work from home, air quotes there, work from home. And so these Fortune 500 companies are currently looking at ways at outsourcing jobs that used to be homegrown, if you will, and looking at outsourcing those jobs. So the recovery, I guess, of the unemployment numbers that Matt was talking about, I'd love to see how they came up with those, because I think it's going to take a little bit longer than they think. And especially here in Canada, I think it's going to take even longer. Our economy was not great even before all this business happened. I know the States wasn't, super stellar either, but it was better. And so I think that from an economic standpoint, I think that's a real hard thing to deal with, is to get the labor market back to some semblance of normalcy, I guess, if you want to call it that. As for the Fed, I listened to it. I did a little bit of reading yesterday. I didn't see anything really, that jumped off the page, but now that Matt kind of brings that up to light, yeah, they do kind of like to shy away from the stock market, but I think everybody knows that it's been what's floating it. I've heard probably 1,000 times in the last 5 months, don't fight the Fed, don't fight the Fed, right? Because it seems to be what drives it upwards anyway. So that's kind of how I see it. Again, my biggest concern for both economies is the labor market. And I think it's going to be a struggle going forward. I really do. I'm still not convinced, like the jobs numbers that we're seeing and all that stuff. I'd really love to see how that's calculated and where that comes from, because they just seem absolutely unbelievable from a mainstream point of view. So
I'll tell you exactly how it's calculated. They put a couple numbers in a hat and they drew one out.
Okay, that's kind of where I thought it was coming from, Matt. But I didn't want to go right out and say it.
I'm gonna call a spade on that labor number. That was the biggest BS number I've seen economically in quite some time. That was a complete. I don't even want to say it was a miscalculation. I think it was pure propaganda. Like literally,
I'm Canadian, Matt. We were trying to be kind. You know what I mean? I agree 100%.
Always polite.
Greg,
I will be the first here.
I will be the first one to admit you are a better person than I am, Greg. There is no
Canadians are going to be Canadians, right? Like they're going to be sorry about everything.
Yeah.
So it's all good.
Sorry to interrupt you there, Noe, but you're absolutely right. So economically, I think that's our biggest worry at this point in time. That's how I see it. And I know here in Canada, at least where I live, rural Ontario, the labor market is getting hit really, really hard here. And it's not just COVID. Like COVID obviously had something to do with it, but it's a whole economic slowdown here. A lot of the big companies that are around my area have been cutting jobs even before COVID. So There's a lot of trimming going on, and hopefully we can turn that around. As Matt said, it takes a long time to do that. I'm hoping it takes less time than we think it will. So.
Yeah. Crude oil and then gold, then the dollar. Let's keep working through our top-down analysis. One thing about this reopening theme and those jobs number, they take a lot longer to come back. Obviously, you guys have mentioned that. If this is a virus risk, you think there would be risk here to crude oil. Crude oil is down about 8% on the day, but that's after a historic run. Greg, I know you've been doing a lot of day trading with crude oil. That's been one of the things you've shifted to day trading a little bit during these conditions, I think, as the volatility has been there. What's your read on crude right now, Greg, and then Mark?
Well, see, and this is the problem being a day trader. I only read it for about 4 minutes at a time. So, but really, we're coming into a known resistance zone there, right around that 40 price level there. Like you said, where I live, I don't want to say surrounded by oil companies, but I kind of am. And I know that there's some struggles there. So I think crude, from a fundamental standpoint, is still got some more downside to it. And this might be the catalyst, or it might be the area, I should say, that old support there coming, new resistance. I think we've got another pullback in the works here. How deep it goes, I don't really know. I think this was a little overcooked as well, much like everything else in the market. The response from the beatdown was just parabolic in my estimation. So, from a macro perspective, that's what I see. Like I said, because I day trade, I use a 5 and a 1 minute chart. The macro level of it doesn't really matter that much to the day traders, but to the overall swing traders, that's how I see it.
Mark, you weren't here yesterday. Obviously, we were talking though throughout the day.
I know, and I wanted to take today off too, and tomorrow off.
Too important of a day.
And S&P's down, what it is, so here we are.
But I want to get your take, because yesterday there was an economic data point on crude where we had a huge build in supply, and I saw a few headlines about supply concerns and whatnot. What are the sewing circles saying on that front?
Sewing circle's not very happy right now. And I mentioned this earlier in the week that they're getting a little jittery, right? There's some things, the things coming out of OPEC weren't, the things coming out of the meeting. Yes, we are actually, the whole storage issue that oil traders have put to the back of their head. The data that came out on Wednesday said we are at a record level, actually. The storage issue was such, hey, sent to negative prices, right? It's worse than it has been yet, because we just can't drain that supply out because there's no demand. And so that storage issue that supposedly was gone, reversing the other direction, and a lot of the sewing circle thought that because the rig counts are going so low, and they are, they dropped again last week, like 12 rigs or something. They're just really, really bottoming. The storage issue hasn't gone away. Don't want to scare oil people, right? But I'm going to scare oil people a little bit right now. Those July contracts only have 11 days on them left. The storage issue hasn't gone away. It's literally, by all mathematical calculations, worse than it's been even at the time where we were a little while ago. So throw on a day like today, I don't know, there's just some jittery stuff right there. Goldman downgrading. It hasn't been a good week on the backdrop of oil at all this week.
A technician probably likes any pullback here though, Matt. You take all of that out of it, any of the analysis in terms of storage and supply and all those concerns. We did hit a known resistance zone, and it might pull back into an old resistance and find the 20-day moving average. Matt, are you still looking at this as a bullish trend, an opportunity to the upside? Matt is on.
I had mute on. One down day doesn't make a bearish trend. So yes, this is still a bullish trend. There's no doubt about that. You're above the rising 20, you're above the rising 50, you're above historical support there, or old resistance to support at 35. I could absolutely see traders coming in at 35 with stop losses under 35 if you see some slowing momentum here. For me, I don't like rounding tops. I saw this as a high base. I still see it as that. So I could definitely understand a trader coming in with a bounce off 35 with the stop underneath 35, and I would not fault them for that at all. I would like to see a little bit of a recovery more than that. I still like the potential breakout of 40 here. I do agree with Mark. The data yesterday, the build up when we were expecting to see a drawdown to continue further that fundamental argument that, supply is coming out, demand is picking back up. We've seen, week after week after week of data, rig counts going down and supply going down as well. But to see the buildup yesterday was a little concerning. Mark, I read a report here today that we're not at full capacity. We're at about 73.5% capacity. But that number is a historic number because that actually goes back to 1982, where we were coming out of the oil embargo and the complete lack of demand around the world in the 1970s. So it's certainly a concerning number from a supply perspective, and it does throw a little bit of bearish analysis in that bullish argument, no doubt about that. I'm a little bit hesitant here with the drop in oil. Again, I completely understand somebody coming in at above 35 with a stop underneath 35. I would not fault that, especially as a day trade, maybe a 1, 2, 3 day trade. But for me, I'm still waiting on that breakout of 40. If we get it, and if we don't get it, I'm going to miss out on oil.
Yeah, a doji on the 20-day moving average, that would be nice, right?
That'd be nice. Absolutely. And I could see, like I said, I could see traders coming in at that point. But for me, it's kind of the same thing. I know what I want. I'm going to wait till I get it. Maybe I'm a spoiled little teenager in that capacity. But the reality is I'm mapped out a projection. That's when I'm going to wait. And if I don't get it, I don't get it. I'm fine missing out. So, the 35 bounce, if you get it, I can understand traders coming in. But for me, I'm going to wait for that original setup that I want. And if we do see that breakout of 40, you're gonna see that on the backs of some positive data. So, maybe it's going to take 2, 3, 4 days for that to set up, and I'm perfectly fine with that. It's the same concept on the S&P 500 right now. I love the pullback we're seeing. Absolutely love the pullback we're seeing here today, and specifically in those distressed areas. For people that missed out on that epic run in the airlines, in the energy stocks, in those economy reopening up themes of the market, of the distressed areas, this is an opportunity to reestablish those support levels and hit it again. So I really love it. But if we just see the market continue to go down, we're going to miss out on that. And if we see the market completely recover tomorrow, I'm going to miss out on that. And I'm perfectly fine, because what I need in the S&P, what I need in those distressed areas, I need slowing momentum. I need slowing momentum at those support levels. I need to see a doji tomorrow. That's what I need to see. And if I don't get it, I'm fine with that. I'll miss out on an opportunity on a V-shaped recovery. That's going to happen. But this is what I need in oil. I need to break out of 40. If I don't get it, I'm going to stay away. If I don't get a doji tomorrow on Delta and American Airlines, JetBlue, Carnival Cruise Lines, the energy plays, the industrial reopening economy plays, that's fine. It's okay to miss out on an opportunity instead of taking a bad trade.
Gold next, if we can here, up at resistance here again, guys. Everything the Fed said yesterday, if there's one thing that came out of for me, it just strengthens your resolve in gold here, don't you think, guys? I mean, 2 years of low interest, and they're willing to do anything. They're not worried about elevated asset prices. Doesn't that just put another nail in this kind of thesis here around gold, Matt, from a fundamental perspective?
Yeah. If you want to understand how dovish the Fed was yesterday, don't focus on politicians saying whatever about the Fed. If you want to focus on how dovish it is, look at the response to gold yesterday after the Fed did what they did. The Fed, I agree with Mark when he said that was one of the most dovish things I've ever seen out of the Fed. What the Fed has been doing in the last 9 months, and specifically the last 2 months, and quite frankly, yesterday, I mean, they were Mark McGuire and Jose Canseco taking steroid shots in 1987 yesterday. They were literally as dovish as they could be. No interest rate hikes, an expansion of the balance sheet, ending tapering. I mean, you talk about dovish. I mean, it was just like, hold my beer. Who can be the biggest dove? There's no hawks at the Fed right now. And so, yes, what the Fed did yesterday can do two things. It can support asset prices in both the stock market as well as in gold. Bad for the dollar, good for gold, good for stocks.
Greg, I believe you've been also day trading some gold here recently. Crude gold, some of the most popular products by veteran traders, professional traders, those types. What's your read on the gold markets right now, Greg? Because I know this is one market that you track a lot as well.
Yeah, ever since the coronavirus and that recent pullback in the S&P 500 month and a half, 2 months ago, them coming out and saying, we will do whatever it takes to support the economy and to do all this. And that just, from a guy from rural Canada here, that just screams, we're going to print a whole bunch of greenbacks, right? So, from a long-term perspective, I think gold's heading north, no question about it. We're actually seeing some lower peaks there. I actually expected, with the exception of the last couple of trading sessions, I actually expected just maybe a smidge deeper pullback there that we didn't get. And then, as Matt said yesterday, after the Fed came out and basically, just I don't know, sat in the corner sucking their thumb or whatever they did, and it popped up. I think we're waiting for that breakout now up above the 1750. I just think it's going north, and from a longer term perspective, we could get another pullback maybe, from a technical perspective, because like I said, we are making some pivot lows, like lower pivot highs there. I think long term, when you're going to destroy your currency by printing copious amounts of money, I think the only way that can go is north. So that's how I'm seeing it right now. If you're day trading it like I am, again, and it's the same as crude for me. The overall trend doesn't matter because I look at it such a short time frame. But from an overall trading perspective, yeah, long gold for sure.
Yeah,
you might have missed it, but that was a world-class Canadian insult when Greg said they're sitting there sucking their thumb. That's outright vulgarity in Canada. So
good catch. I did miss that one, actually. I picked that up as an insult.
Sorry about that, Mark. I'll send you some maple syrup.
I mean, that's just offensive. I mean, that's some Canadian real foul language right there. So
all I'm going to say is that is a bigger insult than what I said to Tim earlier today.
That's funny. The dollar here, last one on the top down side of it, and then we're going to get into individual companies here. UUP or the DXY. I think UUP is the better chart in Thinkorswim these days. Found a little support. It feels like a move to safety kind of day, though. That's still a downtrend, and support is still in play, obviously. Matt, unpack that chart if you can real quick.
Overextend to the downside, you can see some consolidation, maybe in a bearish retracement. But yeah, what the Fed did yesterday, I loved Greg's comment, copious amounts of money. That is putting it lightly, no doubt about that. But yeah, when you're trying to destroy your currency, and that's what the Fed is doing, guys. They're trying to devalue the currency to help the economy, help exports. But you don't want to fight the Fed in the stock market, and you don't want to fight the Fed against the dollar right now. So you're having a little bit of recovery today. Maybe it's a safe haven play. Maybe it's just an overextended play coming back up, shorts covering, and so on and so forth. But I'm not looking to be a buyer of the dollar at all. I'm looking for proper setups in the currency market right now. Give it a few days of consolidation, maybe a bearish retracement coming back up in to test those resistance levels. But as of right now, it's a stay away for the dollar.
Yeah. All right, guys, that's our market skyline section that we go through each and every day. First thing, obviously, a lot to unpack here today on a pretty amazing day in the market. When you think about it, biggest red candle we've had in quite some time. Markets are down on a lot of stated headlines we've been analyzing now for a little bit. Let's move on to stocks. And during our stock talk section, a couple of things I do want to take a peek at before we do. I always like to promote something. And with Greg here, the one thing, Noah, bring up the website if you can. I'm going to give Greg a good old pitch for his blog here. Just highlight the blogs. And one of my favorite blogs at Tackle Trading, they're all great, but I love the Rookie Corner blog. I like the way you approach it, Greg. I know that you care about it. I can feel that when you're reading it and going through it. There's no doubt about it. Today's blog that just came out today was amazing. I really enjoyed it on the hubris and all that stuff about markets. Greg, talk a little bit about your blog if you can. How do you enjoy it? How do you approach it? What are you trying to communicate with the rookies out there that are new to trading?
Well, when we started that, what is it, 2-3 years ago? I really wanted to take somebody from A to Z. So if you go back far enough, I really tried to break down, my evolution as a rookie trader, kind of maybe not what I did, but what I needed to know, and the process that you have to go through, the maturation process, if you will. I started out that way, and then the blog evolved into, I get questions from students all the time. I get questions from Tackle community members. I get topics between coaches, just things that we muse about. And, those give me some good ideas to kind of reinforce lessons that I've learned as a trader, in my journey, to becoming a professional trader, things that I've learned that maybe I can share with somebody else. And if it can help them, make less mistakes, or, improve their profit ratios, or just find a path, just a path, any path, right? Because I think, we could all sit here and ask, ask ourselves if our paths were probably all different in the way we came to trading. And so I kind of just trying to give whatever I can from a knowledge nugget, or an introspective or something like that. I try to throw that into the blog, as well as I try to give, like last week, I did a video, on the way I use the moving averages, right? It might be a little different than some people use them. So whatever it is that comes to me in the blog, I want to get value to the trading community, the tackle traders. And that's, it's a love. It's a love for me. I enjoy immensely doing the blog. It's a lot of fun. It allows me to connect with the students and the community members. And yeah, it's been a pleasure to work on it for the last couple of years now.
By the way, if you're a pro member out there and you do read the blog, one great thing to do, you might not know how far this goes for somebody who's a content creator and, putting their heart into something like this. Leave a comment in the blog. Just tell Greg if you enjoyed it or what you learned from it. I know that, Greg, that would be well received. And I hear all kinds of positive comments from students on your blogs all the time, quite frankly. I love what you're doing there. Keep up the good work. Let's unpack some companies if we can here. Let's start actually with Amazon and IBM. One of those two. I find this to be an interesting bit of news here, Matt. You brought this up to me this morning in terms of Amazon approaching, I think, facial recognition software and whatnot. Walk us through this one if you can, quick, Matty. And by the way, now this is twice. He made fun of me yesterday for being on mute. He said at least 2 times a day, I got to get Tim to come off mute.
Didn't give me 2 seconds to click unmute. I was listening to Greg talk and I didn't want background noise. I was trying to be respectful to my Canadian friend. Like always. He is always respectful to me. So that's my excuse, Greg. It honestly had absolutely nothing to do with it.
I got your back, buddy.
I will say it publicly. But no, the IBM and Amazon news, it's not news that's going to impact their stock price, in my opinion. IBM down day today just because IBM's down because the market's down. Amazon up today because Amazon's up because of the stay-at-home play. Those are the 2 reasons. IBM market-driven, Amazon stay-at-home driven. But the news was interesting. Both Amazon's pulling their facial recognition software from the police force for the next year. So they're banning utilization of their facial recognition software. IBM is stopping facial recognition completely. And it's a controversial subject, obviously, specifically the news that was happening out of Hong Kong during not the current protests, but the protests that were happening last year. So it was just interesting news more than anything, Tim.
Mm-hmm. Yeah, and I think you're going to see more of this. By the way, that speaking of Hong Kong, it was another story almost in line with this. Did you see this? The news around Zoom technology? They suspended one of the protesters in Hong Kong who was using Zoom to broadcast some of his protesters, and they had to actually delete his account. And Zoom is trying to figure out from a regulatory perspective how to do business in different countries. And, they're free speech people from the US corporation, all that kind of stuff. But the government there in Hong Kong and China basically said, you cannot allow anti-Chinese demonstrations through Zoom. And they actually did suspend the account. So I think you're going to see more stories around how tech interacts with the public, not just here in the US, but globally. And that the facial recognition stuff is disconcerting to anybody who has privacy concerns. I did find it interesting as well, Matt. Another one as well, Grubhub has been in the news for the last couple of weeks here. The original idea was they were going to have some merger with Uber. And Matt, Grubhub came out basically today and said, no, thank you. We got a better deal. What was your reaction to this one? Anything there on that?
I was a little surprised that the deal came so quickly after the news happened with Uber yesterday. Uber and Grub talked yesterday, ended their merger talks over antitrust concerns. That was the news headline yesterday. Grub comes out today and said, the CEO of Grub comes out and says it was not over antitrust concerns, even though I do believe there were antitrust concerns since we're talking about the 2 largest food delivery companies in the United States. Mm-hmm. Again, just to remind people, simply because 2 companies want to merge doesn't mean they're going to get approval out of the United States government. So I do believe there was antitrust concerns. I think the CEO is just is moving away from that at this point. But their CEO did come out and say that they simply wanted to take a better deal from, I believe it was Just Eat Takeaway, a European company. And so Just Eat came in with a price offering of combined $75 per share. Uber's price offering was between $65 and $67 per share. And so they did announce that merger with Just Eat Takeaway last night. And you're seeing a little bit of price response here today. But on the news, if the market, this deal is not expected to be done until the first quarter of 2021. So the market's still a little hesitant with Grub, making sure that, we've seen this song and dance before. Let's wait to see if it actually confirms.
Next one I want to look at here is Hertz or Chesapeake, either one of these bankruptcy plays. I want to get Mark in on this one, actually.
Honestly, we should stop analyzing bankrupt plays because that's how insane they are.
But isn't there a huge, easy lesson to learn here? I mean, they spiked it, but now we're down here. I mean, Mark, Hertz down another 11% today. It came off the top there at 5. We've tracked the data. We know it's Robinhood users. Matt had a really good study there that he found where we looked at how much volume was being participated by the retail traders and companies like this. Obviously, it's coming back down here. Mark, what would you teach somebody? What lessons can you learn from these
Max
bankruptcy
Loss
plays?
is getting these people, right? Max Loss mock when Hertz was skyrocketing on Monday, that big green candle on the podcast. Max Loss made an appearance just mocking these individuals because it was the easy. Max Loss was just salivating at come on. What did you think Hertz is going to do? Go to 15 when it was bankrupt, people? And yet I guarantee people bought at 5.25. It's like, the bankrupt companies are not great investments. Now, if you want to trade anything, listen, God bless, right? But you can't short Hertz. You can't short it. You can only buy it. You could buy puts. You can do whatever. Trade anything, right? Day trade anything. But like investing, come on. It's a bankrupt company.
Yeah. And look at the chart on CHK if you can hear Noah as well. I mean, same kind of thing. This whole thing. And we've been talking about these bankruptcies here for a few days. Look at that thing gap out on, what was it, Monday, I believe. It traded actually up near, $60, $70 a share. We're back down to
77, like that. 19 to 77, 15 to 77 in 2 days.
There's a lot of lessons to learn from the hubris in this market.
Yeah, Matt's right. We should stop analyzing them because there's no analysis. They're bankrupt.
I just want to point out that somebody literally bought the high there. Some poor soul bought the 77.50 high.
That is a classic blow-off pattern, you guys. That is classic.
I do think it's worth 30 seconds of commentary to make fun of uneducated individuals.
Well, then you guys are going to love this one. Let's take a look at
very quickly on this. Mark, you said on Hertz, and I don't want to beat a dead horse here, but you said this on Hertz. You can't short it, which means you can't short it. But you can buy put options on it, okay, to protect it. But here's the problem with buying put options, okay? You're spending 7 to 8% of the equity value to protect the company, and you're only protecting 18% of the equity value by doing so. The at-the-money put strike 127 days out has an 18 delta, which means you are only protecting 18% by buying an at-the-money put option. This is insane. I mean, absolutely insane. And I can't wait to see this on social media constantly. Oh, I'm the one who sold the top. You're going to see it constantly. Oh, I made so much money trading these bankrupt companies, and I got out before it ever. No, you didn't. You held the bag and you took it in the shorts. Okay. Do not trade bankrupt companies. The example that these individuals are pointing to justify their logic in trading bankrupt companies is 2002, when American Airlines filed Chapter 11 bankruptcy, and their company went up and up and up and up. The difference between Chesapeake, the difference between Hertz, the difference between these bankrupt companies and American Airlines is the United States government will not allow American Airlines to actually go out of business. There is a substantial difference in those two evaluations.
Mhm. And along these same lines, by the way, one of the most incredible charts that I've seen in a long time is this duo, DUO, if we can here. I got to tell you guys, I don't even know how to unpack this news right here. What happened?
Tim, it reminded me of the time when
Zoom
Zoom went up like 500% in a day because retail investors thought that was the actual Zoom IPO, which was ZM. And so, and it was funny. I remember spotting that on the day and literally calling it out that day. That's what happened here. This is a stock that's been traded, for months and months and months and has done nothing. And all of a sudden, 3 days ago, it just goes up just like gangbusters because retail thought this was an ETF. I'm dead serious here, guys. Retail thought this was an ETF that tracks Facebook, Apple, Microsoft, Amazon, Google. And I just want to remind people of something. The value of an ETF goes at the value of those stocks. Do you really think Apple, Microsoft, Google, Amazon, Google, all these stocks go up 40, 50, 60% in a day? They can't do it. There's too many shares. They're too liquid. They're too traditional. Apple's market cap is $1.5 trillion. Do you really think it's going to be $3 trillion in a day? Come on, guys. Retail, get it together. Come to Tackle Trading. We'll teach you how not to be dumb.
Look at the volume. That's incredible. I think they only traded look at the volume a few days before that. Didn't they only trade
You can't
like
even
a few?
see it. That's how bad it is, Tim. Hold on.
I think they only trade like 4,000 or 5,000 shares a day, and then they had like 1 million shares that one day. How would you even have found this as a retail guy and being like, is it just on the gainers list?
How they found it? No, how they found it is they pushed it through, their social media, word of mouth. Hey, do you see Duo? It's tracking Fang. Let's get in. It's insane. It's insanity.
Less than 10,000 shares a day. Like it doesn't even show up.
Know what you're trading, people.
Now the most sophisticated argument I've found on this is that these low float stocks, these really low traded stocks, that individuals buy them when they're in these low base patterns, and then they have this boiler room type thing where a bunch of people get in and trigger it all together.
Pump and dump.
Oh, Lord Almighty, Mark, I'm watching Boiler Room later today. That is a perfect assessment. This is Ben Affleck selling this to a bunch of people who don't understand. They're literally calling people up. Hey, have you seen Duo? It's up 50%. You want to double your money, buy that new home? Let's go get this.
Pick up the phone. Pick up the phone. Start dialing.
What a great movie. One of the great trading movies of all time. We had some of those debates back on the podcast in the day. Just crazy to me. Obviously, just crazy news. We don't have to spend too much time on them. Matt, upgrades, downgrades. I know you had a few of them. Highlight the ones you want to hit. Let's go through them.
Well, the big one's Apple. I mean, everybody jumped on Apple here today. And I mean, they are chasing dreams here with Apple and that breakout play we saw here. By the way, a retracement on Apple, everybody should trigger on that one. So let's watch Apple play out over the next few days. But Apple got a triple upgrade today. Wells Fargo upgrades Apple's price target to 385. Bank of America raises Apple's price target to 390. Greg's personal bank of choice, the one he highly recommends to absolutely everybody, HSBC, also upgraded Apple as well. Greg, how many times have you told me how much you just love the ethical and moral nature of HSBC? I mean, they compete with Deutsche Bank on the quality of banks out there, no doubt about that.
Isn't HSBC also the one that backed Enron?
Yeah, we're not going to talk about their problems.
I think they are.
Well, wait a second. How can we have Wells Fargo upgrading anybody when their stock is getting taken out to the woodshed?
Okay,
isn't that a conflict of interest?
Pull up DB for a second. I've had this problem with DB for a very long time. They do their upgrades and downgrades, and this company can't figure out how to actually be a decent bank. So run your bank first. Okay,
yeah,
you shouldn't be telling anybody else. Run your bank first. Also, Apple, triple whammy of upgrades. Also, Starbucks got downgraded here today on the backs of their report that came out yesterday that they were on track to lose $3 billion in the quarter. So let's take a quick technical look there at Starbucks, Noah.
Hey, if I could chime in on that one, they're supposed to be
ahead.
closing 200 stores in Canada. So I guess you guys will be the
Wait,
only
they
ones.
have 200 stores in Canada?
You guys will be the only ones buying $7 lattes now. We're
I
going to go
thought that
back to
was
Tim Hortons where we
Tim
should have been in the
Hortons
first
turf,
place.
yeah.
Greg,
Starbucks is everywhere.
I brew my own coffee, my friend. Starbucks is not as good as Folgers. It's just not.
Right on. Good to hear.
Uber and Lyft also got upgrades here today. So let's take a look at Uber's chart. Any interest, guys, with the upgrade on Uber obviously coming down here today, but kissing off that 200-day moving average. Any interest here, guys?
No, I haven't seen. Are they making any money yet?
I can see it.
Greg,
No.
don't talk to me about fundamental analysis. Don't talk to me about
I'm so
positivity.
old school that I like when a company actually makes money. What was I thinking? I guess I should just go for the bankrupt companies. Wait a second, are they going
Greg,
bankrupt? So
we
if they're
like
going
to-
bankrupt,
we
I'll
like
buy them right
companies-
now. I'll buy 100
we
shares
like
right now if
companies.
they're going bankrupt.
We like companies that don't make money, have no sales, and have no path to profitability. That's what we like here.
Nice.
But there's Uber. Lyft also got an upgrade here. So I'm taking a collective no off the 200-day moving average from the team here.
Or no.
I might be able to find better setups, Matt.
I mean, I
Okay.
see it. I'd have to look at it compared to other tech firms, but yeah.
All right, let's take a look at Lyft very quickly. They also got an upgrade here today. All right, you got to pick one. No fence sitters here, boys. You got to pick one, Uber or Lyft if you had to choose. And your holding is not trading. Your holding is the next end of the year, 6 months.
I'm locked in.
Oof.
I know exactly.
No.
Should we-
You can't tell me what to do.
Yes, I can.
Do a quick locked in. So you got to pick. Don't tell us.
So, okay, I got to pick. I got to
Locked in.
pick. Everybody locked in?
I'm locked
Yeah.
in. I know what I'm going to pick. Yep.
Okay, I'm gonna start with Tim. Tim, I'm gonna get 4 for 4 wrong, by the way. Tim, I'm gonna go with you on Lyft.
100%.
Okay.
I'm a believer in Lyft. I'm not a believer in Uber. So
Okay. Greg, I'm gonna go with Lyft for you as well.
Yep. Why?
Okay.
That's
No,
a question.
Noah, I'm gonna go with
I'll walk. Thanks. I mean, wait,
Noah,
I'll take
I'm gonna go. Noah's gonna have whatever scooter company has free scooters on the sidewalk, whatever company that is.
Yeah, no doubt.
And Mark, I'm gonna go with you on just to play contrarian. I'm gonna go Uber on Mark.
I am Uber because if I was
Boom.
holding forever,
Great,
it would be Lyft. But since I'm 6 months, I can only lose $3,200 on Uber, and I can lose $3,600 on Lyft.
I had the analysis spot on, 100% spot on there.
I love it.
Lyft got an upgrade. Also, upgrade downgrades. DraftKings, guys, DKNG got upgraded here today. Any interest, guys? That
Yes.
I see a nice stop loss under 35 here.
Yeah.
Golf's coming back today. We could start betting on it. These guys are going to the moon, man.
Hey, if you don't
Golf and
think I'm
rugby.
going to be watching golf, I am watching golf today. You guys are not going to catch me. I am watching every hole. I'm going to PGAlive.com and I am watching golf. I'm watching it all day long. And then Tim, next week we are going to the golf course. We're having a tackle trading meeting on the golf course. No, that's how we're going to justify spending money. So just deal with it.
I like
Hey,
it.
but
I
that's what we're doing.
I can't get a flight out to Utah. That doesn't work for me. They won't let me leave
No,
the
get
country.
on your horse and get down here. We know you guys don't have cars up
All right,
there.
it's gonna take me about a month and a half to ride my horse that far. So
Yeah, we'll get a tea time ready for you, buddy.
Thanks,
So DraftKings, yes or no? Entry above the high, stop under 35. Anybody?
Sure.
I
I'm
don't love the
interested.
entry. I
The
don't love the
trigger, I'm
entry.
not sure of. Yeah, I might want to wait till it gets above the 9 EMA, but I'm interested in this pullback for sure. Yeah, I think you
I'm-
could debate the trigger.
I'm really
Okay.
interested if you go sideways for a few days. Like
Sure.
stay above that 20-day moving average, couple days sideways movement, clear multi-day resistance level to break. Yeah, I'd be interested in that.
Yeah, I'm interested here. I'd like to see that 35 support level hold. I'd like to see how Noah's random, color of whatever moving average he has there. I'd like to see that hold as well. But I think that's something we should be tracking on a daily basis until we see something set up. I do like that setup on DraftKings though. And then JP Morgan had a little bit of a housing sector breakdown. They said, you know what? We like Pulte Group, PHM. We don't like DH Horton. So they upgraded Pulte, they downgraded DH Horton. Those were the major upgrade downgrades here today. Any interest in either one? DH Horton, by the way, I like the home builders from a covered call perspective. You know, I know, Greg, you love covered calls. That this is an area of the market I do like covered calls. My favorite is Toll Brothers. DH Horton, a nice little tackle 25 stock this year. Toll Brothers last year. I mean, breaking down, I truly don't understand how. I did more analysis on the home builders trying to select what home builder to put on the tackle 25 than I did any other industry for the tackle 25 this year. And I could not find a discernible difference in the fundamental data between any of these housing. So I don't understand what JP Morgan's looking there on their upgrade downgrade, but Pulte got an upgrade. DH Horton got a downgrade. Those are upgrades, downgrades, major ones anyways.
I like the pullback in home builders. I think there's a bunch of them. I'd have to look at all the charts across the entire sector. I mean, KBH actually kind of grabbing my attention a little bit here. But you got some earnings coming up. Yeah, Matt, I love these stocks. And Greg, these are good cover call stocks because they pay those dividends that you love, right?
Yep.
Yeah.
Speaking of dividends, Target TGT here up their dividend payout by 3% from 66 cents to 68 cents today.
Yep. One more area I want to get some analysis on is just XLF. You know, Greg, you brought this up. Mark, you brought it up. Matt, you brought it up. We all talked about the banks here. One of the fallouts from the Fed, and we've been going through some of the charts and all that. These banks are taking it on the chin today, just as if there's red in the market, it's everywhere today, obviously, but really specifically in the banks. These pullbacks feel a little deeper. I mean, you mentioned that JP Morgan, look at JPM or Citigroup or Wells Fargo. Guys, could you go back to neutral or interested in this pullback? I mean, Mark, let's get your take on this first. How's your read on banks here in the last 2 days with the updated charts and the updated kind of reaction to the Fed's announcement yesterday?
Listen, like everything rally that was beat up over the last couple of weeks, right? You had this everything cheap rally. Even if your Carnivals and your MGMs and some of those opening up plays stabilize, you could see banks falling further still, because if it separates, right? Like when everything that was beaten up was rallying, well, everything's going to rally, right? Airlines, everything, banks, everything beat up, refineries, everything. You could see a separation because, I mean, it's a terrible backdrop for banks. It's just a terrible backdrop for banks. And so even if the others stabilize, boy, I'd have to get a much cheaper price on banks to get interested.
Mm-hmm. Greg, you specifically mentioned XLF as well. I mean, what's your read on the banking sector and financials right now?
Well, you know, it's the move that it made recently, right? Like that move up recently in the last, 2.5 weeks, 3 weeks, that was very parabolic. Came right into that I think that's the 200 that Noah's got on there. This thing was due for a pullback. Like it moved up, XLF moved up 21.6% in 10 trading sessions. That's insane. That's an insane move, especially for the issues that they are facing. You know, like I know there hasn't been, that many defaults yet, but I think there's probably some, company defaults coming and who knows what else. And that is going to affect the bottom line of the bank. And I think that's the original, the weakness that we were seeing. And I didn't see a fundamental reason for this big shoot up. And then, like I said, it came parabolically at us. I think this pullback was totally due. Where it levels out, I kind of agree with Mark. I think there's some more downside to it. Looks like it's trying to break below that 20 there. It'll test that 50 for sure.
Yeah. I mean, if you just look at it technically, Matt and Noah, old resistance, new support. I know there's going to be some components in the XLF. They're going to look like good pullbacks. Others like not that great. Matt, what's your read on financials here? I know we already unpacked the Fed news and whatnot, but specifically how that affects banks and some of these lending institutions.
Well, I know Greg doesn't care about companies making money, but I strongly have concerns about how the banks are going to be profitable in this environment. And obviously, I say that tongue in cheek. Both Greg and I focus on economic analysis and fundamentals quite extensively. But you look at some of those distressed areas of the market, and I do have concerns about the banks. I mean, zero interest rate environment. It wasn't just zero interest rate environment, guys. The 30-year mortgage note just literally hit an all-time low today, at an all-time low today. So somebody tried to tell me outside of trading firms how they're going to make money in this environment. And so I am concerned about the banks longer term, but it's not just that. When you're looking at the short-term analysis and you're looking at XLF here, you're underneath that breakout channel at 33 and a half by, 23 and a half by 24. When you're looking at the banks across the board and you're looking at, say, Bank of America here, Bank of America underneath that $25 pivot level currently at 24.25. When you're looking at, JP Morgan, underneath that previous pivot that it had, and the previous pivot on the reversal was right there about 105, currently at 98.25. When you're looking at Wells Fargo, the previous pivot there at 30 is currently at 27.20. So when you're looking at some of these distressed areas of the market, I do think there's going to be some really good short-term trading opportunities. But like I said earlier in the show, those trading opportunities have to have support hold. We have to see support hold in those areas. When you're looking at some of the airlines again, a distressed area of the market that was absolutely going gangbusters in the last few weeks, where did Delta come into? Delta came right smack dab into previous areas of resistance right there at about 28. It's trying to hold its 20-day moving average. When you're looking at JetBlue holding its previous levels of resistance. When you're looking at American, when you're looking at Carnival Cruise Lines, when you're looking at a lot of these areas of the market, Boeing, for example, when you're looking at Boeing, when you're looking at these areas of the market and they're still above their reversal breakout channels, which are the previous levels of resistance, those you can start to see and map out really good trading environments once we see the momentum slow down. I'm not seeing that in the banks here today. I'm seeing banks break those support levels, violate those support levels, and that gives me a little bit of concern. What was good, in my opinion, for the stock market and gold is really bad for banks long term with what the Fed is doing.
Yeah, I'm with you. Guys, we're going to move into our last section here. And by the way, what a wonderful show here. I've enjoyed all the analysis, the fun. Greg, it's great to have you here. You're welcome anytime. As always, couple things real quick as we're transitioning into our Coach's Corner, where we get, some ideas, some thoughts, some last, kind of perspective or opinions on what from each of the coaches as what they're seeing in the market. Before we do that, though, I do want to mention a couple things on our channel. If you're watching right now, I do this at least once a week. Let me know where you're at. We've got our Canadian friend up here. We got a lot of traders from Canada. We got a lot of traders all over the world in the US. I saw somebody from the UK and Europe here earlier that was posting. Just type in where you're watching the show from, because we are #Team Tackle, and we are a global community that is growing and very vibrant. Very proud of that. And if you've not done it yet, click the thumbs up. Let's get the analytics up there. Let's get the word out if you enjoy what we're doing, and subscribe and click the bell. TackleTrading.com. There's a lot of things you can get from there. Obviously, just go and get the email, visit the website. You can kind of navigate around there. We'll explain the 15-day trial right at the end. But let's go around the room here, and let's start with Mark. Coach's Corner, Mark, what are you going to be paying attention to the rest of the day? What's on your radar? What are you focused on?
Well, I mean, I have a number of naked puts at lower levels. Other individuals might as well, right? So, those are long-term investment things. I'm just making sure that I personally am not over leveraged, that if I take ownership, it's in a responsible way. I'm very conservative. So like days like today, like I'm very happy with my conservative nature, right? Like very happy with my conservative nature, but just making sure that I can sleep tonight. Like I never want to go to bed worried what the market will do the next day. That's why when I wake up on a day like today, I'm not panicked. I'm not in a bad mood. I'm interested, right? The market's fascinating. Trading's amazing. So just making sure that I'm responsibly managing my portfolio so that I can sleep at night and wake up and see if there's opportunities tomorrow. And I'm sure Matt and others will say this too, of course, looking for technical setups to develop in some of these pullbacks.
Mm-hmm. Noah, you're up next. What are you paying attention to? What's on your radar?
Well, I'm really keeping my eye on Apple and Microsoft on these pullbacks. I like them. I like them a lot. So just a game of patience for me. Just watching some of my favorite charts on this pullbacks, looking for opportunities.
Awesome. Greg, what's on your radar? What are you paying attention to the rest of the day? What are you focused on for the rest of the week?
Well, obviously watching the broad market, I need to see how deep this pullback goes, whether it turns into something more than it is. Really watching the 20 very close today. I've been of the same mindset, even with this pretty strong recovery that we've had recently. I've been of the mindset that we're still in a bearish type volatile market. And so for me, I think, I think I've been acting more this way recently. You have to be quick with your trades. You have to take the profits when you get them. You have to be, very conscientious of your stop losses and where you're going to get out. Basically, same thing we always do, but I think the time frame is shortened for what we do. You really have to have a good solid exit plan. For myself, I'm watching the blue chips. You know me, I'm a covered call guy by nature. I'm always looking for bargains. So I've got a few stocks on my radar that I'd love to load up on, and we'll see if they can find levels of support. If they can, I'll buy them and create some cash flow. It's really what, you add that into my day trading and the little bit of swing trading I do, and that's really my world. So.
Yeah. Covered calls are an interesting strategy, obviously, in these kind of conditions. I think you got to have your mechanics down. There's so many lessons from the last few months for covered call traders rolling up, knowing where to set those levels, how to protect on the downside. But here's the thing, Greg, somebody like you who's been in this game for a long time and you know what your targets are. I know how you are a conservative cash flow guy, adding other systems in, like you just mentioned. You're going to trade covered calls in almost all markets, correct? I mean, that's one of your core strategies.
Yeah, it kind of goes back to what I was saying. You have to be nimble, right? You can't let things get too far away from you. If they're hitting your strikes, you got to be willing to pull the trigger, roll them out, look for those credits, maybe give a little bit more time if it's working against you. Obviously I don't just work the one side of the market. I'm like Mark as well. I'll get those naked puts on there. My job, as an investor, from that side of the game is I need to get that cost basis down as low as possible. And that comes from selling credit on both sides of it. In this market, I think you just got to be faster at it. You got to be willing to roll. You may either that, like recently with the pullback we had in February and March there, just a massive opportunity to pick up some really world-class companies and get your cost basis down low so that now you can sell these these covered calls, and you can sell them at levels that it might not be near the money, but you can sell them at levels that you're still collecting a real nice income. I think the other part of that is you really need the skill of doing in the money covered calls and things like that. Protection, from, protected puts, callers, all that kind of, you have to have all that in your repertoire, especially when the speed of the market picks up. And definitely this market, the swings and the speed is much different than it was, 3 months ago. So.
Yeah, I love it. And if you want to write a little bit about the basics of cover calls in your rookie blog, I think that'd be well received at some point down the road. So fantastic, obviously. A couple from me, and then I'll get Matt's final thoughts on the whole market and whatnot. Not, obviously, I'm just watching the distress pullbacks like you guys are. I don't think I'll make any new entries on the long side here today. I can't imagine. We're all waiting for like that doji setup confirmation. It might not even be till next week, right? If you're swing trading, those kind of things. But some on the distress that are grabbing my attention. Look at Las Vegas Sands LVS. I'm interested in that little channel developing. It needs to cook here for a couple days. PXD, Pioneer Natural Resources in the energy sector, Noah.
Which one?
PXD.
PXD?
Mm-hmm. Same kind of thing, touched the 200. Now we're coming back off of that. I'm interested in that pullback back into the rising moving averages. And then one last one here on the bull side, PLNT. This is one of those companies we had the debates on in the podcast about 3 weeks ago or so about which of the distressed areas we're interested in. The breakout was clean 2 weeks ago. Now we're pulling back into old resistance. Some interest in that chart as well. And then one on the bear side for me is PFE, which was on the reports from over the weekend. Obviously, that thing did break and run here. It's one of the reasons why you got to have a bull team and a bears team. We talked about that through this week. I think it's an important exercise in technical discipline, technical analysis, and trading to always have a bull watch list and a bear watch list and be ready for whatever the markets are going to give you. Because at the end of the day, we don't determine what the market price action is going to be. We can react to it, we can trade it, we can prepare for it, but that's not, we don't get to decide what the markets are going to do. Matt, you final thoughts? Markets are pressing down here near 3K on the S&P. What are you paying attention to? Last thing.
You know, again, coming back to what I was talking about, what I needed earlier today. I like the pullback. It's overdue for a pullback. But before we rush out to just jump into some of these retracements, we got to see that slow down. We got to see them confirm. Be patient. It's okay to miss out on a potential trade setup in the short term. As a trader for many, many, many years, you want to be trading 5, 10, 20 years from now. And to be able to do that, you got to have a plan and stick to the plan. And the last thought I really have, Tim, outside of just being patient and waiting for these retracements to set up, is I'm willing to bet that there are millions of new traders that have been introduced into this market in the last 2.5 months, and specifically over the last month, that were aggressively day trading, stocks, aggressively swing trading stocks. And I'm willing to bet that they didn't have proper stop loss placement, proper position sizing. And I'm also willing to bet that they have adjusted their plan completely to turn a day trade into an investment, because now they're all upside down on their short-term trades, which means they're going to start talking about, well, I really like this stock long-term. I like the fundamental values long-term. You don't want to turn a day trade into an investment simply because you had improper money management, lacked position sizing rules, and lacked stop loss placement. And if there's one thing that days like today, remind me of, after euphoric price movements we've seen in the last month, where everybody's celebrating their wins and scoreboard pointing, it's education. Education is so vitally important to do this business long term. Do not put short-term satisfaction and short-term analysis in front of the long-term. Education allows you to be an investor, to handle any market condition, up, down, sideways, market cycles, fundamentals, the uncertainty, all of that. It allows you to approach this market with a plan, execute your plan. Don't shift timeframes just to justify a loss. Learn how to take a loss. One of the most important things you will ever learn as a trader is to accept when you're wrong and to click that sell button to accept that you have a loss. Plan the trade the plan. Don't adjust this simply because you don't want to take a loss. Put education in front of application. Make sure that you're here for the long term, not for just short-term gratification.
Yeah. And with that last thought here, we always do this at the end of the show, is just kind of explaining our pro membership. And guys, if you're looking for a community and education, that's what we do here, and if you're new to our channel, you obviously see we have a lot of fun. We break down markets. We're veteran traders. We've got a dynamic list of coaches and a lot of different content. Right on the website, you can find, a 15-day trial, I believe, right there. If you see, click start my trial, start your 15-day trial and join the other community members. It's a yellow button right below you there, Noah. There's also a link in the description, in the comments, and in the chat. I'm going to drop it in here in our YouTube comments as well right now. Guys, it's a pretty simple offer. We do a lot of things on the back end. We have webinars like tonight. There's a cash flow club where I believe it's Coach Gino tonight. Is that right, Mark?
Yes. No, it's Tyler tonight.
Coach Tyler tonight, teaching cash flow principles. We have our reports over the weekend. We have our daily traders lounges. Noah, got a lot of good comments from your lounge here this morning here in the chat. People were appreciative of that. I know Tyler's going to be teaching lounge tomorrow. It's really hard to explain everything we do. There's courses, there's blogs like Greg's, Rookie Corner blog, but it's a pretty simple offer to explain. It's 15 days for free, so you can try it out and see what it's like to join an actual education community of people that are moving forward and growing together. Pretty simple, easy. Come and join us. Don't hesitate. I think it's a great time to do it, especially with the markets kicking in the way they are. Fantastic, everybody. Really enjoyed the show. Greg, again, thanks for being here. You're welcome anytime, my friend. Great job, everybody else out there. We are going to wrap this one for today. We're out. We'll see you back here tomorrow on our Friday Fun Day.